Inflation is a term frequently discussed, often with concern, across headlines and dinner tables. It represents a pervasive economic phenomenon that touches nearly every aspect of our financial lives. Its effects are far-reaching, influencing everything from the cost of groceries to the value of national debt. However, despite its universal impact, the narrative around inflation often simplifies its complex nature. It is not merely a force of economic erosion. Rather, it redistributes wealth and burdens in intricate ways. This redistribution creates both winners and losers within the economic landscape. This brings us to a fundamental, yet frequently overlooked question. Who truly benefits from inflation? A superficial glance suggests everyone suffers, but a deeper analysis reveals a more nuanced truth. Understanding this distinction is crucial for comprehending economic realities. Unpacking this question challenges our basic assumptions about fairness and economic equilibrium. It forces us to look beyond immediate price hikes to the underlying mechanisms of monetary policy and wealth transfer. We must examine the various stakeholders within an economy. Our exploration will reveal that while inflation can be a destructive force for many, it simultaneously creates opportunities and advantages for a select few. This uneven distribution is a key characteristic of its true impact. To understand who benefits, we must first clearly define inflation itself. At its core, inflation is understood as a sustained increase in the general price level of goods and services in an economy over a period of time. It is not merely a single price going up, but an economy-wide trend. The most direct and widely recognized consequence of inflation is a decrease in the purchasing power of money. This means that each unit of currency buys fewer goods and services than it did previously. Your money simply isn't worth as much as it once was. Consider this impact. A specific amount of currency, say $1 or £1, will over time purchase a smaller quantity of items. This erosion of value is often subtle at first, but becomes painfully apparent over months and years. It affects every transaction. This diminished purchasing power can be felt in daily life, from the rising cost of a morning coffee to the increasing price of housing. It necessitates earning more money just to maintain the same standard of living. It's a continuous battle against rising costs. Essentially, inflation acts as a hidden tax on cash holdings and fixed incomes. It quietly reduces the real value of savings and future earnings. This fundamental impact sets the stage for understanding its uneven distribution of effects. One of the most significant, and often least discussed beneficiaries of inflation is the government itself. While governments publicly aim to keep inflation in check, it often provides them with substantial financial advantages. These benefits can significantly ease national budgetary pressures. First, governments often see increased tax revenues during inflationary periods. As prices for goods and services rise, so too do the nominal incomes and profits of individuals and businesses. This leads to higher income tax collections and increased sales tax revenues. Furthermore, properties and assets appreciate in nominal value, often leading to higher property taxes. The increased tax base provides more resources for government spending without necessarily needing to raise tax rates overtly. It's a revenue boost by stealth. Perhaps the most potent advantage for governments is the reduction in the real value of their outstanding debts. Most national debts are fixed in nominal terms. As inflation erodes the purchasing power of money, the real burden of repaying those debts diminishes. This means the government can effectively pay back its creditors with money that is worth less than what it borrowed. It eases the burden of debt repayment, making large national debts more manageable over time. This is a powerful, implicit default. In essence, inflation acts as a mechanism for governments to partially inflate away their debt obligations. It provides a less painful alternative to direct taxation or austerity measures. This makes it an alluring, if often unstated, policy outcome. Certain businesses can also find themselves in a beneficial position, particularly in the short term, during periods of rising inflation. This advantage often stems from timing and market dynamics. They can react quickly to changing economic conditions. When inflation begins to accelerate, businesses often have the ability to raise the prices of their products and services relatively quickly. They can pass on anticipated cost increases to consumers before their own operational expenses fully catch up. This creates a temporary buffer. This lag between rising product prices and the adjustment of input costs, such as wages, raw materials, or rent, can lead to a boost in reported profits. Companies can expand their profit margins, at least until these other costs eventually rise to meet the new price levels. Early movers in an inflationary environment can capture greater revenue for a period. This allows them to accumulate capital or reinvest before the full effects of inflation erode their margins. It offers a window of opportunity for enhanced profitability. However, this benefit is typically short-lived. As inflation persists, employees demand higher wages, suppliers increase their prices, and other operational costs inevitably adjust upwards. The initial profit surge eventually normalizes or diminishes. Therefore, for businesses, the benefit of inflation is often tactical and transient. It favors those agile enough to adjust their pricing rapidly ahead of rising costs, securing a temporary advantage in the market. Those who lag behind suffer. Holders of tangible and financial assets often see their nominal wealth increase during inflationary periods. This category includes individuals and entities who own real estate, stocks, commodities, and other investments that are not fixed income. They are often insulated. As the purchasing power of currency declines, the nominal value of these assets tends to rise. For instance, real estate prices often increase with inflation, as the cost of building new properties and the value of existing ones are driven up. This provides a hedge. Similarly, equity investments such as stocks can also benefit. Companies often raise their prices, leading to increased revenues and profits, which can translate into higher stock valuations. This is especially true for businesses with pricing power. Commodities like gold, silver, and oil are frequently seen as inflation hedges. Their prices tend to increase as the value of fiat currency diminishes, making them attractive stores of value. Investors flock to them during uncertain times. This rise in nominal value creates a sense of prosperity for asset holders. Their portfolios appear to grow, even if the real purchasing power increase is marginal or in line with inflation itself. It provides a psychological boost, if not always a real one. This is a significant distinction. Asset holders often maintain their wealth or even see nominal gains, while those holding cash or fixed income investments watch their savings erode. It highlights a critical aspect of wealth inequality during inflation. While some entities benefit, it is crucial to recognize that the benefits of inflation are far from evenly distributed across society. In fact, inflation often creates significant economic disparities, exacerbating existing inequalities. The impact is profoundly asymmetric. Those who suffer most acutely are individuals on fixed incomes. This demographic primarily includes retirees who depend on pensions or fixed Social Security payments. Their income streams do not adjust upward with rising prices. As the cost of essential goods and services relentlessly climbs, the purchasing power of their static income steadily erodes. What once comfortably covered expenses now barely stretches to meet basic needs. Their financial security diminishes rapidly. Furthermore, individuals with significant savings held in cash or low-interest savings accounts also face a severe erosion of their wealth. The real value of their hard-earned money diminishes with each passing day. Their financial prudence is undermined. This group experiences a direct and undeniable decline in their standard of living. Their ability to maintain their previous quality of life is severely compromised. Inflation effectively acts as a direct tax on their stability and future. The system unfairly punishes those who played by the rules of saving and prudent financial planning. It shifts wealth away from them towards those who hold assets or can leverage debt. This fundamental injustice fuels social discontent. For the vast majority of the general public, inflation manifests as a tangible and painful decline in living standards. This is particularly true for those with limited disposable income or who are not asset holders. Their daily lives become a struggle. The increased cost of essential goods and services directly impacts household budgets. Food, housing, transportation, and utilities all become more expensive, often at a pace that outstrips wage growth. Discretionary spending evaporates. Families find it increasingly difficult to make ends meet, stretching their incomes further and further. What was once considered affordable suddenly becomes a luxury, or even unattainable. This can lead to significant financial stress and hardship. This erosion of purchasing power limits access to basic necessities and opportunities for personal growth. It can mean fewer healthy meals, postponement of education, or inability to afford necessary medical care. The quality of life suffers. In severe or prolonged inflationary periods, this economic pressure can lead to broader social unrest and political instability. When large segments of the population feel their economic future is shrinking, societal tensions inevitably rise. The struggle for survival becomes paramount, diverting energy and resources away from productive endeavors. This undermines societal cohesion and trust in economic institutions. It creates a climate of anxiety and fear. The impact of inflation is not uniform across different countries and economies. It varies significantly based on a multitude of factors. A nation's economic structure, its reliance on imports, and its policy responses all play a critical role. Developing economies, often more reliant on imported goods and capital, can be particularly vulnerable to global inflation. Rising international prices for essentials like energy or food can quickly destabilize their domestic markets. Their currencies weaken. Conversely, some nations, particularly those with strong export sectors in commodities whose prices are rising, might experience a temporary economic boost. Their terms of trade improve, providing a short-term advantage. This creates a global imbalance. A country's ability to manage the effects of inflation depends heavily on the effectiveness of its monetary and fiscal policies. Strong central banks and prudent government spending can help mitigate the worst impacts. Weak governance exacerbates issues. Nations with high levels of foreign-denominated debt can face a double whammy. Their local currency depreciates, making their dollar or euro-denominated debt more expensive to service. This can lead to debt crises and default. Ultimately, inflation can create global imbalances, shifting wealth and power between nations. It can intensify economic competition and trade disputes as countries scramble to protect their own interests. International stability is challenged. Beyond the immediate redistributive effects, inflation, particularly when prolonged or uncontrolled, carries severe long-term consequences for an economy and society. Its insidious nature undermines foundational economic principles. One of the most damaging long-term effects is the erosion of trust in the national currency. If people lose faith in money's ability to retain value, they will seek alternatives, leading to capital flight or the adoption of other currencies. This weakens sovereign control. Furthermore, persistent inflation can destabilize financial markets. Uncertainty about future prices makes long-term planning difficult for businesses and investors. This leads to reduced investment and economic stagnation. Risk premiums rise. It also hinders overall economic growth. When businesses cannot accurately forecast costs and revenues, they are less likely to invest in expansion, innovation, or hiring. This stifles productivity gains and job creation. Confidence evaporates. In extreme cases, unchecked inflation can lead to hyperinflation, a truly catastrophic scenario where money rapidly loses all value. This results in the collapse of economic systems and widespread societal chaos. History offers stark warnings. This potential for a vicious cycle, where rising prices lead to demands for higher wages, which in turn push prices even higher, is a constant threat. Breaking this cycle requires painful economic adjustments and strong political will. It becomes clear that inflation is far more than a simple matter of clear winners and losers. Its impact is not a straightforward equation, but rather a complex interplay of economic forces, individual circumstances, and policy choices. The popular notion that everyone suffers equally from inflation is a convenient simplification that obscures its true nature. Such an assumption prevents a genuine understanding of wealth transfers and economic power dynamics. It deflects accountability. A deeper analysis reveals that while consumers generally face higher prices, certain segments of society are systematically positioned to weather and even profit from these conditions. This is not accidental, but structural. It challenges us to look beyond the immediate price tags to the underlying mechanisms of monetary policy, debt management, and asset ownership. These are the levers that determine who gains and who loses. The system is rigged for some. Recognizing these complexities is essential for a mature understanding of economics. It moves us past simplistic narratives to acknowledge the intricate, often opaque, ways in which economic forces shape our lives. It demands critical thought. Understanding inflation requires dissecting its anatomy, not just observing its symptoms. It forces us to question the fairness and equity of our economic structures. The truth is often uncomfortable, but necessary for informed debate. So, who are the true beneficiaries of inflation when all the layers are peeled back? They are predominantly those best positioned to exploit its effects, often at the expense of the wider populace. This group holds structural advantages. Governments, through the stealth tax of inflation, reduce the real burden of their national debts and increase their tax revenues without politically unpopular direct tax hikes. They manage their financial obligations by stealth. Businesses, especially those with pricing power and quick adaptation strategies, can secure short-term profit boosts before their costs fully adjust. They capitalize on the lag in economic response. Agility becomes profitability. Asset holders, particularly those with investments in real estate, equities, or commodities, often see the nominal value of their wealth appreciate, providing a hedge against the erosion of currency. Their existing wealth provides insulation. These groups are not merely passive recipients. They are often actively engaged in economic activities that leverage the inflationary environment. They possess the tools and knowledge to navigate its turbulent waters. This is a harsh economic reality. For the ordinary citizen, particularly those on fixed incomes or with limited assets, inflation represents a continuous struggle to maintain their standard of living. It is a constant battle against forces beyond their control. Inflation, therefore, is not a neutral force. It is a powerful economic tool that, whether intentionally or unintentionally, redistributes wealth upwards, and from the less financially agile to the more established. It's a fundamental transfer of value. Our journey through the landscape of inflation has unveiled a phenomenon far more intricate than its common perception. It is not merely a blanket rise in prices, but a dynamic force with profound and uneven consequences. While the general public often experiences inflation as a detrimental erosion of purchasing power, specific entities gain short-term advantages. These include governments, certain businesses, and holders of appreciating assets. Their positions offer resilience. The analysis challenges the simplistic assumption that inflation is universally bad for everyone. Instead, it reveals a complex interplay of economic forces that systematically transfer wealth and burden across different segments of society. This understanding demands a critical examination of underlying economic systems and mechanisms. It compels us to question the fairness and stability inherent in our current financial structures. Are these outcomes by design or accident? Ultimately, exploring who truly benefits from inflation forces us to confront a significant economic reality. It asks us to consider the ultimate cost of inflation, not just in terms of eroded currency value, but in terms of social equity and long-term stability.